Okay, capital gains tax CGT. So you can write that as a new topic. Write this. This is a tax which is charged on gains. This is a tax which is charged on gains. Tax which is charged on gains from disposal of marketable securities. Tax which is charged on gains from disposal of marketable securities and immovable properties. Disposal of marketable securities and immovable properties. That's capital gains tax. Okay, allow me to open my Excel document here. Allow me to open it so that I'll be jotting some information on the Excel. So, effective date for capital gains was 1 August 1981. 1 August 1981. So some may simply say, may extend the definition and say after 1 August 1981, which is still fine because that was the effective date we had this capital gains tax. Capital gains tax. Then write this. For the year ended 31 December 2020, for the year ended 31 December 2020, comma, disposals of marketable securities and immovable properties are deemed to be in foreign currency. Disposals of marketable securities and immovable properties are deemed to be in foreign currency. Are deemed to be in foreign currency. Unless there is documentary evidence to prove otherwise. Unless there is documentary evidence to prove otherwise. Unless there's documentary evidence to prove otherwise. So that one is a very important point. 2020. Why Why 2020? So we are saying, oh, write this. Marketable securities and immovable properties are collectively known as specified assets. Marketable securities and immovable properties are collectively known as specified assets. Marketable securities and immovable properties are collectively referred to as specified assets. Are collectively referred to as specified assets. Right? So what is it that I'm referring to? So for the year ended 2020, disposals, so that you have written that point already, disposals of specified assets. By specified assets, we mean marketable securities and immovable property are deemed to be in foreign currency. To be in foreign currency. Why this distinction matters? It's because it was a change from 2019. But when you are revising using any other paper or books, normally the authors of books are yet to update this fact. So for 2019, it was like this, though it's no longer relevant. But I just want you to make a distinction, because when you are revising a 2019 paper, it was like this. For the year ended 21/2019. For 2019, it's like immovable properties. Immovable properties acquired before 22 February. Immovable properties acquired before 22 February 2019. Capital gains tax, which was CGT, was acquired before 2019 and disposed thereafter. CGT was 5% of gross proceeds in the currency of disposal. Meaning the currency in which it was sold for. So if you had sold it in RTGS, capital gains tax was just 5% of whatever you got. That was for 2019. Then if you dispose it after 22, if you acquire it after 22 February, it was then the normal computation. But now this requirement is no longer there in 2020. But because textbooks are yet to update to 2020, you may find textbooks still giving you the 22 February date, cutoff date. It's no longer relevant in 2020. Because in 2020, for administrative convenience in these capital gains tax issues, we just assumed that every disposal of specified assets was in foreign currency unless you provide documentary evidence to the commissioner that it was in any other currency. By foreign currency, normally they are referring to as US dollars. So the implication of that is it's an offense actually to declare on capital gains tax that you sold a house in RTGS. Actually, it's not. You are violating the statute to declare. You have a burden of proof to the commissioner that was it really in RTGS. You get that because of this particular act. So we are not, whenever you are hearing or you are reading when there is 22 February cutoff, 22 February 2019 cutoff, ignore that part. Whatever you'll be reading, use this. Whatever was referred to as 22 February was overridden by the foreign currency issue. This was meant because some were saying we are selling in RTGS, some were saying we are selling in some were saying we are selling in US. So to the commissioner, it was like, well, if whatever you have sold in RTGS, you acquired it before 22 February, you just pay 5%. If you acquired it after, you just calculate it like the usual way. So this one is no longer relevant. So allow me then to take it out. But as you are revising, there's chances that you may be debating and say, say gave us notes with this, but we are seeing this. No, that one is already outdated because it was 2019. Rates of capital gains tax. Rates of capital gains tax, CGT. Meaning how do you tax capital gains when you're calculating, right? So listed marketable securities, disposal of listed marketable securities, disposal of listed marketable. Sorry, it's making a lot of. Juliet, please mute. Disposal of listed marketable securities. Listed marketable securities. If you dispose listed marketable securities, then CGT is 1% of gross sales proceeds. Gross sales proceeds. All right? Whatever you sell the listed marketable securities, the capital gains is 1% of the gross sales proceeds. Actually, it being 1%, it is deducted at the source. It is deducted at the source. It is deducted at the source. At the source, meaning when I dispose shares to you, when I dispose shares to you, like I sell shares to you, what happens is the amount that I get is net of capital gains tax. You pay me the net. You pay me the net if I dispose shares to you, because capital marketable securities, it is deducted at the source, meaning it's withholding tax. It is a withholding tax. So the seller gets the net proceeds, and the seller receives the net proceeds. That's what it means when you are saying it's a withholding tax. The seller receives the net proceeds. You get it? Then number 2, disposal of unlisted securities. Disposal of unlisted securities. Disposal of unlisted securities. If you dispose securities which are not listed on Zimbabwe Stock Exchange, CGT is 20% of the gain, of the capital gain. Capital gain. 20% of capital gain. Full stop. Then the capital gain is calculated as follows. Capital gain is calculated as follows. Now notice capital gains are assumed to be calculated in foreign currency. So if you are given the amounts in RTGS, for example, suppose you are given the amount in RTGS by the examiner. The assumption is documentary evidence was provided to the commissioner. If you are given the amount in RTGS, so because I said disposals of specified assets are deemed to be in foreign currency unless documentary evidence. Let me finish. You have written that and say unless documentary evidence is provided to prove otherwise. Evidence is provided to prove otherwise. So when we are doing questions on capital gains, we shall be even if the question is in forex, just calculate it in the manner we are doing it here. Even if the question is in RTGS, calculate it, because if the question is in RTGS, the assumption is the commissioner was furnished with documentary evidence. That's the issue. Documentary evidence was given to the commissioner. So capital gain is calculated as follows for disposal of unlisted securities. So you have it like this. You say disposal proceeds, you put XXX, and then you say deductions, or you may say less exemptions, if there's an exemption, less exemption. We shall discuss what amounts normally qualify as exemptions for capital gains tax. All right. Less exemptions. Then what you get is called capital amount. And then you say deductions. Now these are now deductions. Deductions are amounts which qualify as deductions in terms of Capital Gains Tax Act. These are no longer deductions from income. You know, there's Income Tax Act and there's Capital Gains Tax Act. So deductions are no longer deductions like like capital allowances and stuff that we used to. These are now deductions for Capital Gains Tax Act. If you dispose shares, what are the deductions? Cost of securities. You know, by securities we mean shares and debentures. Those securities which can be which you use to raise money, shares, debentures, etc. Cost of the asset, cost of that security. Then there is inflation allowance. Now inflation allowance is 2.5% per year. 2.5% per year per annum on cost allowance. It will be 2.5% from the year you purchased it up, including the year of disposal. You add inflation allowance, and then sales commission. You have your sales commission here. All this is cost. If you are given any other cost, you put it here, and then what you then get is the total deductions. And then you get, after saying capital amount less deductions, what you get is called capital gain. Capital gain like this. Then you say less. Then you say CGT at 20%. Capital gains tax at, let me put in caps, CGT at 20%. then put capital gains tax at 20%. So this is how you calculate capital. You estimate capital gains on disposal of marketable securities. On disposals of marketable securities. Now, I always emphasize, when you're doing 2019 papers, there was 22 February cutoff line. For 2020, never mind about the 22 February. Because we are assuming that everything is in foreign currency unless documentary evidence is provided to prove otherwise. So all you do is to perform your computations like this, regardless of whether it was 22 February, it was before 22 February or after 22 February 2019. Because of this was the only provision in 2020 concerning Capital Gains Tax Act. Right. So if anyone asks you, or suppose you are doing a question paper for 2019 and you see they've not worked it like how we are working it here, always remember this was the provision which overrode all those provisions. Right. So what I want now is, if you're doing any, I was in a CFA lecture just now. I was in lectures from 9 a.m. I haven't rested till now. No wonder why when you guys, I say let's meet in a lecture, you have a tendency of thinking that Say was resting since morning and is now just. Can you imagine? I was in lectures since 9 a.m. and I will end my lectures at 8:30 p.m. non-stop. Now, can you imagine if I then say, let us meet at 5:30 and nobody shows up? To you, you'll be thinking that, well, Say was just resting somehow. So no, I'll be very busy and I'll then say, where are these guys? No wonder why this was my time to rest. So I had to ndakatokunzwira itsitsi ndikatarika ndichingokupa yangu lesson. During 2014, Chipo sold the following shares. So I said there's no more need for you to, it's a matter of answering it as if it's 2020. So it's like during 20, Chipo sold the following shares. Shares in a company listed on Zimbabwe Stock Exchange for total proceeds of 35,000. The shares had originally cost 17,500 when purchased on 1 March 2009. Shares acquired in Grain Limited, an unlisted company, for a total proceeds of 31,500. The shares had originally cost 18,000 when purchased in 2010. What is Chipo's final capital gains tax liability in connection with the disposal of these shares? So let us see what will be Chipo's capital gains tax liability. Now, for shares which are listed on the Zimbabwe Stock Exchange, I said capital gains is simply 1% of gross proceeds. So it's a matter of now saying, illustration. Remember, you still have the video, so you don't lose anything. If you want to read on capital gains, you come back to your video and play. So this is 2015. I just picked a question because I knew the question was there. So it's like CGT from listed shares, capital gains tax from disposal of listed shares, Simply say 1% times disposal proceeds, which is 35,000. So Chipo would have capital gains of 350 here. Then you have disposal of unlisted securities. Also of unlisted securities. Now on unlisted securities, what will be the gain? What will be the capital gain? you just do it like this, guys. You simply say sales proceeds, sold it for 31,500. So there you go. So you say disposal proceeds, 31,500. Then you say, the exemptions. There's no exemption here. I shall teach you shortly what are exemptions for capital gains tax. And then you say cost, or you then come to deductions. Deductions, what did I say? I say when you're coming up with deductions, you say cost of these shares was 18,000. They were for 18,000, as you can see here. The shares had cost 18,000, so this is the cost. And they were purchased in June 2010. So they were purchased in June 2010 and disposed in 2014. So you put what is called inflation allowance. Inflation allowance. Inflation allowance. It's 2.5% per year, straight line. 2.5% times how many years do we have from 2010 to 2014? Now I said inflation allowance is even deducted in the year of disposal. So it will be 2010, 2011, 2012, 2013, 2014. So it's 2.5% times 18,000 because it is on cost, multiplied by 5 years. Are you not seeing? I have included even 2014. Inflation allowance, we include even year of disposal. You get that? We include even the year of disposal. Even if unlike what we do with capital allowances, where we exclude year of disposal, but with inflation allowance, we include it. So it's 2.025 times this times 5. Inflation allowance was that. So what you then do, you then need to add it to calculate the capital gains here. Whether there was a gain or what, equals this, equals minus, open bracket, this plus this, then you close bracket. So what was the capital gain there? The capital gain was 11,250. So this one was capital gain. And then you have capital gains tax at 20%, which is equals to this times 0.2 to 250. So the question was total capital gains tax liability, total CGT liability, total capital gains tax liability. We are now saying 350 plus 250 get equals 250 plus 350. So total capital gains is 2,600. That's what the examiner wanted. So you'd notice this is exactly what we're supposed to do, 2.6. So the answer was B. You get it? And then continuing. So remember we said capital gains tax, it's a tax which is levied on disposal of marketable securities and immovable property. Not movable, but immovable, like land. Like you can have land if you dispose a dam, if you dispose building, if you dispose a house, a jewel. All these are immovable property. Swimming pools. But if you dispose machinery, if you dispose all these, no, those ones are not capital gains tax. Those are not capital gains. They are not specified assets. Now, 3, disposal of immovable property. Disposal of immovable property. Movable properties. Because I had given you how to calculate when you dispose marketable securities, but now when you dispose immovable properties, now when it comes to immovable properties, there's no talk of listed or unlisted. No, immovable properties, we don't consider that. What can be listed are shares and debentures, not in property. So here's how you calculate the CGT. 20% of the capital gain. The gain is calculated as follows. Now, on this one, that's where I said make a distinction between 2019 and 2020. In 2019, they used it to say if that property was acquired before 22 February 2019, capital gains was 5% of gross proceeds. If it was acquired after, it was then 20% of the gain. That requirement is no longer there in 2020 because the assumption is all disposals are now deemed to be in foreign currency. So there's no more need for you to say, was it acquired prior? Was it acquired after? No. So here is now how you proceed. Capital gain is calculated as for you say gross proceeds, you say disposal proceeds, you put them here. And then you say less recoupment, if any. That is recoupment. Disposal proceeds less recoupment. You want what you get. What you get is you say disposal proceeds less recoupment and perhaps less exemptions. Less exemptions. Less exemptions. Less exemptions. What you get again is called capital amount. Capital amount. You get capital amount. Capital amount. You know, capital gains tax, it's in your exam, so you need to know it. All topics in taxation are examinable. Taxation doesn't leave out a single topic. So you can't say, is it sure that we are going to find the VAT? It's actually obvious that VAT is examinable. So now here, so you say you then say deductions. Here are your deductions for the purpose of capital gains tax. These are your deductions. You say cost of the asset. If there were any improvements, so you say cost of the property. This will be cost of property. Now, then you also say cost of improvements, if any. You know, you can buy a house without a jurao, and then you put a jurao. So the cost of the property, which is the house, need to be adjusted with the cost of the jurao. And then you say inflation allowance per annum on cost. So inflation allowance, it is on cost and also on improvements. On cost of property and of improvements. So even if you apply inflation allowance on cost of property, you equally apply inflation allowance on improvements. Remember, it's 2.5% per annum. Then you say less capital allowances. Allowances granted for income tax. You know, I shall explain this shortly. You say less capital allowances granted for income tax. Notice where we deduct them. We are deducting capital allowances from cost. We are removing them from deductions, and then you say selling expenses. You know, if you are selling a house, there are selling expenses, e.g. agency fees, right? And what you do then is you add all this up, and what you then get here is capital gains. Capital gain. After adding your deductions here, you get capital gain. And then the answer that you get after getting capital gain, you then say CGT at 20%. Actually, it's either capital gain or capital loss. It's not always a gain. It may either be a gain or a loss. It may either be a gain or a loss. Write this. So like points to note. Now these are the most important points we need to take note of. If there is a capital loss, if there is a capital loss, you know, capital loss, we are saying deductions exceeding capital amount, deductions greater than capital amount, so it gives you capital loss. Exceed capital amount, what you get is capital loss. Then such capital losses are carried forward. Such capital losses are carried forward indefinitely. Such capital losses are carried forward indefinitely. So when there is capital loss, you carry them forward indefinitely. What do we mean by carrying them forward indefinitely? They are allowed as deductions. They are allowed as deductions when calculating capital gains tax in future. They are allowed as deduction when calculating future. Right. So you carry them forward. Suppose here there was a notice. Suppose there was a loss of 2,000 where we have written capital gain here. Suppose it was a capital loss of 2,000. Meaning, when we calculate capital gains in future, in these deductions here, this capital loss, we will include it amongst the deductions. Similar to assessed loss. Remember, assessed loss, we included them as deductions in future. But the difference between treatment of assessed loss and capital loss is this. Assessed losses, we can only carry them forward up to a period of 6 years. But capital losses, even if we make a capital loss today and then we sell specified assets in 2035 or in 2040, capital loss that we make today, we can still deduct it in 2040. But if it was an assessed loss, we don't carry them forward beyond 6 years. So these are points to note. That was number one. Number two, exemptions. You need to know what amounts are exempt in terms of Capital Gains Tax Act. There are various amounts which are exempt in terms of Capital Gains Tax Act. Number one, disposals of specified assets by an executor in a deceased estate. Disposals of specified assets by an executor in a deceased estate. So what it means is if someone dies and the properties of that person are being sold to dispose or to liquidate the estate, of course there will be capital gains, but such a gain is exempt. It's not considered it's not considered for capital gains tax purposes. And then number two, disposal of principal private residence by an elder. Disposal of PPR, principal private residence, by an elder. Disposal of principal private residence by an elder, meaning someone who is 55 years plus, 55 years and above at the date of disposal. Someone who is 55 years and above at the date of disposal is called an elder. So what is a principal private residence? PPR is the sole residence of the taxpayer. PPR is sole residence. It's the sole residence of the taxpayer. It's a sole residence of the taxpayer, occupied for at least 4 years. Occupied for at least 4 years. Occupied for at least 4 years. And another thing concerning PPR is, and includes adjacent properties such as cottages. Includes adjacent properties such as cottages. You get it? You need to understand what is a PPR. PPR imba yekugara. Imba inogarwa na taxpayer ndo inonzi PPR. Saka chinoitika ndechichi, ukadisposa PPR iwewe kana wa 55 years and above, hapana capital gains tax because uri elder. But ziva kuti PPR iyi kuti iqualify inofanira kunge iri sole residence, and also wakai reside in that for at least 4 years. And include also zvimwe dzimba dzipa, even kana uine main uchigara kumain house, hatingangoti PPR main house pamba pako paine macottages ndako yese futi, they are part of PPR. Saka ukadisposa PPR uri elder, hapana capital gains tax. Another is disposal of specified assets. Disposals of specified assets by an employer in an employee share ownership schemes. Employee share ownership schemes, If employees they have share options, share ownership, some call them options, share ownership schemes. So if you as an employer, you granted share options to your employees, and the share options are now due, so that employees can buy them from the employer. So under the circumstances, they are exempt from capital gains tax because they are specified assets, remember. Number 3. Number 4 is, we are still on exemptions. Transfer of specified assets, transfer of let's say of PPR, let's say PPR between spouses, a divorce order. So if you are divorcing, and you say this house belongs to this, it's a deemed sale, but again it's exempt for capital gains tax. Or transfer of PP, or disposal of PPR, and using war of proceeds, and using the war of proceeds to acquire another PPR in Zimbabwe within 2 years. So what happens is, suppose you dispose PPR in, where you were living in Gweru, you sold your house in Gweru for 200,000, and then after selling your house in Gweru for 200,000 years, you come here and buy another house, suppose in Newlands, for 200,000 or 250. If you buy a house in Newlands for 250, it means the entire 200,000 that you got, you used them all to buy another house, and you paid the extra 50 also. So we can't say there is capital gains tax. This requirement has nothing to do with you being an elder or not. This requirement. But still on this, the issue then is, if part of the proceeds, this, what I've written here is called rollover provision, right? This is known as rollover provision. This is known as rollover provision. A rollover provision. You get it? It's a rollover provision. So still on rollover provision, let me expand it and say, however, if part of the proceeds, if only part of the proceeds, say 60% were used to acquire another PPR, were used to acquire another PPR, then 40% of the capital gain is taxable. 40% of the capital gain. So if you sell a house for 500,000 and you use 300,000 to buy another house, but 200 you use it for something else, What it means is we calculate capital gains as usual and then tax the 40% of it. So what this phrase means is capital gain is calculated as usual. Capital gain is calculated as usual using full proceeds, and then only 40% of the gain is then taxable. Only 40% of the gain will then be taxed. Will then be taxed. We call this rollover provision. Consistent with rollover provision, it's also right. This rollover provision also applies. Rollover provision also applies to companies selling immovable property and using part of the sales proceeds using part or all of. They may use part or all of the sales proceeds to acquire another immovable property. Notice here, if a company like OK Zimbabwe sells its branch in Westgate, for example, or sells its branch in Fakose, for example, and it sells the building, if all of the proceeds are used to construct or acquire another building, to construct or acquire, it is the same, then no capital gains tax arises. But if it only uses 50% of the proceeds to acquire or construct another building, then we calculate capital gains using the full proceeds. Meaning, unocalculate capital gains uchita sekunge hapana chakaitika kusvika wawana pa capital gain. Usati wati CGT at 20%, unozobva wazoti since 60% dzakashandiswa kutenga imwe OK kana kutenga imwe building, kureva kuti pagain yabuda iyi takungotekesa 40% of it. Saka zvaunoita unenge wakuti capital gain wobva wati unoti capital gain wobva wazoti pazasi recognized gain, wobva wazoti chi CGT at 20%. So unenge wakuti capital gain yako waiweka calculated as normal way. Not capital gain calculated normal way on full proceeds. Uchishandisa maproceeds acho ese full proceeds. Kana tichiti normal way ndiri kuti unenge waicalculata zvatangoita pamusoro apa ndo inonzi normal way ish. Apa unenge wakaisa full proceeds. After waisa full proceeds, unofanira kuiwana wobva wati this is my capital gain. Wobva wati capital gain yako iyi yabuda. Unobva wazoti recognized gain. Recognized gain. Now recognized gain inenge yavachi inenge iri amount which you have not spent, so like this, say 40% not spent on rollover, meaning you did not spend it when you roll over the proceeds. So it will be 40% of this. Then you skip a line and then say CGT at 20%, and then you get your answer here. That's what I'm saying on rollover provisions. All right. So these are some of the common examples of amounts which are exempt in capital gains tax. These are the most common ones. And then let us, some may say listed securities are exempt. When you hear people saying listed securities are disposal from listed securities are exempt, it's because on listed securities we said capital gains is 1% of gross proceeds, and the seller receives net. Because we said the seller receives net, no wonder why in certain textbooks they say if you dispose listed securities, they are exempt from capital gains tax. It's not necessarily they are exempt per se, but it is because as a seller, tax is withheld at the source and you receive net. So let me put it here as number 5. Number 5. Disposal of listed securities. You now understand why disposal of listed securities. No, this is exempt because with capital gains tax is deducted at the source. This is exempt because capital gains tax CGT is deducted or withheld. It is withheld at the source. So whenever you cite listed securities, make sure you complete it with that statement. It is exempt because CGT is withheld at the source. So I am teaching here the words that we were using here, like inflation allowance. Inflation allowance is granted on cost per annum straight line. So it's no longer under exemptions, it's something else. You write it as a subheading. Inflation allowance. Right? This is granted. This is granted at 2.5% per annum on cost. It's granted at 2.5% per annum on cost. Per annum on cost. Straight line. Straight line, meaning there's no time apportionment. Straight line, including in the year of disposal. Including in the year of disposal. All right. Other statements, let me not write, but let me explain them to you. Notice, we said disposal proceeds less recoupment. Disposal proceeds less recoupment. Reason why recoupment is deducted is because recoupment is taxed under Income Tax Act. Let me repeat. Recoupment is not a capital gain. So if I dispose a commercial building, there is recoupment that arises. And the recoupment is not a capital income. It's an income tax. It's a gross income. You know, there is capital income and there is gross income. Gross income is regulated under Income Tax Act. Capital incomes, like capital gains and stuff, are regulated under Capital Gains Tax Act. These are two separate acts. They are two separate acts. So if I sell my building, industrial building, recoupment will arise. So I need to calculate recoupment. But remember, recoupment is included in disposal proceeds. So I recognize the fact that recoupment is taxed under Income Tax Act. No wonder why I take it out here. Because recoupment is taxed under Income Tax Act. It's not taxed under capital gains tax. You get that? So the same applies. If I say deductions, cost of the property here, If I say cost here, I then need to remove capital allowances, because capital allowances are deductions under income tax. Capital allowances are deductions under income tax. So I need to remove them from cost, otherwise I will benefit twice. If I take the cost in full, including capital allowances, I then benefit twice. Because capital allowances were deductions in Income Tax Act, and they are now deductions under Capital Gains Tax Act. So I will then benefit twice. The reason why I remove them from tax here is to acknowledge that if I leave them there, there will be double deduction in income tax and in under capital gains tax. So the commissioner doesn't want you to have double deduction. You get that? Deemed sales, right? That is the subheading. Deemed sales of specified assets. Deemed sales of specified assets. Deemed sales of specified assets. What by this we're saying, whenever you come across this term which says deemed sales means it's not like a normal sale per se, but by the interpretation of the law, we call it a sale. Like, for example, execution of court order sales. Execution of court order sales. Court order sales. Like, you fail to pay your loan. Suppose you had a loan from CBZ Bank and you failed to pay, and they attach your property. So in other words, when they attach your property, it means it's now to be auctioned. So if it's court order sales, then the amount at which the asset is sold to be is deemed to be the selling price. It's deemed to be the selling price. Then there is another which is donations of specified assets. Donations of specified assets. If you donate, what we do is the market value at the date of donation is deemed to be the selling. The market value at the date of donation is deemed to be selling price. The market value at the date of donation is deemed to be the selling price. Right? Deemed sales, we are saying if these things, okay, you have to pay capital gains tax. You have to pay. No wonder why we are saying deemed sales. Then forced relocations. Forced locations. Forced relocations. It's like, e.g., when constructing a road, construction of a road forces the firm to be relocated. Forces the firm to be relocated or given compensation. No, you suppose there's a dualization of Masvingo Highway. Dualization meaning they now want to make it a four-way traffic. If they now want to make it a four-way traffic, it would mean that some buildings which are in the vicinity of the road, you may be forced to relocate, or government may give you compensation. Now, if that is the case, compensation received is deemed to be the selling price. Compensation received is to be selling price. Compensation received is deemed to be the selling price for CGT calculation, for CGT computation, for CGT computation. Then write this, however, comma, no CGT arises. No CGT arises if the whole of the compensation received is used to acquire another immovable property in Zimbabwe within 2 years. Immovable property in Zim within 2 years. Notice all the codes. It's not like, oh, you have to acquire immovable property in Zimbabwe within 2 years. That's what, remember, we said it's called a rollover provision. This is called rollover provision. We have written it up above, rollover provision. So if you use everything to acquire another immovable property, there's no capital gains tax. But if you use part of it, we tax the portion. So if you use 80% to acquire another property, we calculate capital gains with the full proceeds, and then it takes 20% of the gain. And then another, it's damage to specified property, damage to specified assets. You know, that's number 4. This where a specified asset is damaged and compensation from insurance is received. Where a specified asset is damaged and insurance compensation is received, insurance compensation is received, comma, then the amount of compensation is deemed to be the selling price. The amount of compensation is deemed to be the selling price. The amount of compensation is deemed to be the selling price. Just open brackets and say, however, comma, a rollover provision also applies. The rollover provision also applies. Write this, write as a subheading, transfer of assets between spouses or companies under the same control. Transfer of assets between spouses. Transfer of specified assets, actually it's specified assets between spouses or companies under the same control. Companies under the same control. Write this, where a specified asset is transferred between spouses or companies under the same control, comma, where a specified asset is transferred between spouses or companies under the same control, comma, is transferred between spouses or companies under the same control, comma, the transferor, meaning the one who is transferring, the transferor can elect to have the asset transferred at cost. The transferor can elect to have the asset transferred at cost. The transferor can elect to have the asset transferred at cost. Can elect to have the asset transferred at cost. And therefore no capital gains tax arises. And therefore no capital gains tax arises. And therefore no capital gains tax arises. You know, if so this is so important, that if these are spouses or companies under the same control, when they are transferring assets to each other, you can elect to, remember, by assets we are not saying any asset, we are saying specified assets, meaning immovable property and marketable securities. This is what we are referring to. So don't confuse assets and you take even tractors. No, immovable property and marketable securities. Now, if companies under the same control, the one transferring the assets may elect to have so those assets transferred at cost. And unongoziva kuti kana transfer at cost hapasina capital gains nekuti selling price inenge equal to cost, saka pasina gain. Asi asset company yatransferwa kana kuti spouse yatransferwa ma-assets ikazatengesa to third parties, tinozocalculate capital gains sekunge ndiyo yanga iri owner we-asset kubva from the original date of purchase, right? This, however, comma, if the specified assets are eventually sold to third parties, if the specified assets are eventually sold to third parties, if the specified assets are eventually sold to third parties, comma, then capital gains tax will be computed on the basis that, then capital gains tax will be computed on the basis that the party which last owned the assets, the party which last owned the assets the party which last owned the assets had been at all times the owner, from the original date of purchase. He had been at all times the owner from the original date of purchase. Hi Mozi, how are you? Okay, so what was I saying? The party which last owned the assets had been the owner at all times from the original date of purchase. You know, phrase hiyo yekuti had been the owner at all times from the original date of purchase. Phrase hiyo ikureva kuti even kana takucalculate ma-inflation allowances, tinenge takutora tichicalculate from the original date of purchase asi tichicalculatera part yaita yanga yatengesa asset, kwete kuti kubva musi waakatransferwa neimwe part. So maassets kana anga akatengwa 2012 otransferwa to you 2011, I mean otransferwa to you 2015, muri macompanies are under the same control. Kana taakucalculate inflation allowance kana kuti cost, haticalculate cost yawakatransferwa iwewo, tinocalculate cost yakatengwa neoriginal owner, asi as if you were the original owner. Even inflation allowance taakucalculate kubva 2012. Alright? Then suspensive sales. Suspensive sales. Suspensive sales. Some call them suspensive sales or hire purchase sales. Hire purchase sales. Write this. These are sales of immovable property in which are repaid in installments. These are sales of immovable property which are paid in installments. Sales of immovable properties which are paid in installments. Kuti because dzimba adzingobhadharwe dzese kawanda. Imagine utengesa imba woti 600,000. Kashoma kubva wainzi yese 600,000. Unogona kunzi ndinozokupa 250 shamwari. Imwe yacho ndozokupa yearly iri 100,000. Ndo kazhinji materms ari practical pakutengesa maproperties akadaro. Saka kana imba ichibhadharwa in installments, surely commissioner angabva ati ndikuda mari yangu yese at once. Commissioner angabva ati ndikuda mari yangu yese at once. Azvibude zvakanaka. Write this. When this is the case, capital gain is calculated in the normal way. When this is the capital gain is calculated in the normal way. Capital gain is calculated in the normal way. You know, capital gain is calculated in the normal way. You know what I mean? I open a bracket as if the amount was paid in full. As if the amount was paid in full. Capital gain is calculated in the normal way, in brackets, as if the amount was paid in full. Those are some. However, the commissioner grants suspensive sale allowance. The commissioner grants suspensive sales allowance. The commissioner grants suspensive sale allowance. The commissioner grants suspensive sale allowance. Write this. The allowance for each year. The allowance for each year is the capital gain content. Is the capital gain content on the installment debtors outstanding. The allowance for each year is the capital gain content on the installment debtors outstanding. The allowance for each year is the capital gain content on the installment debtors outstanding. The allowance for each year is the capital gain content on the installment debtors outstanding. So what you do is you say suspend, because hausati wabhadharwa mari yacho yese, commissioner hazokutekse gain yese, anokupa inonzi suspensive sale allowance. Calculate so suspensive sale allowance. Unongoti equals, unoti capital gain yaunenge waweka capital gain over sales proceeds. Capital gain over sales proceeds multiplied by installment debtors outstanding at year end. Installment debtors outstanding at year end. Outstanding at year end. That's suspensive sale allowance. Meaning unenge wakuti capital gain calculated in the normal way uchishandisa full proceeds. Unewana capital gain like this. What less suspensive sale allowance. Unongotanga watsvaga capital gain in the normal way. Kana nchiti in the normal way sezvataratidza padenga apo, then unozoti less suspensive sale allowance. Suspensive sale allowance. Capital gain less suspensive sale allowance. Wakuziva kuti inowekwa sei woibvisa. Inosara yacho manje ndo yaunenge wakuti taxable gain. Taxable gain. Wobva waisa taxable capital gain yako. Wobva wazoti CGT at 20%. Wana answer. So commissioner anondokubvisirawo suspensive sale allowance because ana acknowledge the fact kuti hausati waona mari yako yese. Ndo zvaanenge achiacknowledge commissioner izvo. Hausati you are yet to get the full money. Then another thing, right? The suspensive sale allowance for each year. The suspensive sale allowance for each year. The suspensive sale allowance for each year is taxed in the following year of assessment. The suspensive sale allowance for each year is taxed in the following year of assessment. The suspensive sale allowance for each year is taxed in the following year of assessment. That one is a very important point. Get a suspensive sale this year, inozonoedwa next year of assessment. Ganibeta name question, apa ndanyanya kutaurisa. Nongoziya sasei wako, kana vazvinyanyawo vanongo vazvinyanya. Gambovhura question to. Ndakudza kuti capital gains ingoweka, questions capital gains ingoweka as they were. Akambonzi disturb pana 2019 apa but zvakazoshaya basa. Kuda and Tonde. Oh, this paper is, as I said, every question paper unovhura rine capital gains. Saka rikauzovhura capital gains ugoti ndaishaya. Ndiri kuda ine suspensive sale allowance. Akaiona papi. Don't worry, gandirambe ndichitsvaga. Ndingoda ine suspensive sale allowance. Ese ma questions unotoita uchizvimakira, uchizvimakira. Alright, but before ndaita suspensive sale allowance, rega ndingopedza kukupa manotes shortly tibva taita question. Maanswer ndakakutumirai mapapers kana usina piwa nemacolleagues ako kana kuti ndiudze ndikutumire. So that every day unofanira kuita questions e-tax. Ende zvakanakira imimi ndezvokuti mune video. Saka chako iwewe chete kungoplaya video. Mavideo atatu ese haasi kuti unoashaya aripo. And ndotoziya kuti hapana chaunoona muexam kazhinji chaunozoti muvideo hachimo. Ndosikuona ndichiti rega ndikuwedzere. Then let us have capital gains withholding tax. Gain withholding tax. Withholding taxes. Capital gain withholding taxes. Unomboziva kuti nyaya dzema capital gain ndedzoti iwewe ndikakutengesera building kana kuti iwewe ukanditengesera imba. ndiwe unofanira kubhadhara capital gains iwewe wanditengesera imba because ndiwe seller. But kazhinji ndikakupa mari unogona kubva warowa pasi, unogona kubva watoenda zvako. Uku inini ndofanira kuzowana rinonzi title deed remba iyoyo. Kuti ndiwane title deed ndokunge washowa proof yekuti capital gains tax wakaibhadhara. Saka kuavoida situation yekuti iwe ndikakupa mari unobva warowa pasi, ini ndosara ndisina kana kuti ndichaudzani kuti ndiwane title deed. Zvandinoita, taxman ana anonzi withholding taxes. Taxes ekuti haupiwi mari yacho iri yese. Unopiwa net. Reason yaunopirwa net ndekuti nyange ukazotiza hako, at least ini title deed rangu ndoriwana. Title deed rangu ini ndoita sei zvangu ndoriwana. You get it? So these are deducted from sales proceeds like this. These are deducted. They are deducted from sales proceeds and remitted within 3 days to ZWE. They are deducted from sales proceeds and remitted within 3 days to ZWE. Now, notice, reason inobatirwa withholding tax ndekuti tinotya kuti iwe tikakupa mari togona kubva takushaya. Saka tinoziva hedu kuti capital gains tax inowekwa so. Izvi tinozviziva izvi. Kana tiri kuzimura, tinozviziva zvese izvi. Asi anofanira kuweka so ndiwe, kwete zimura. Saka nekutya kuti iwewe tikakupa mari tomboti watengesa imba 200,000, tinogona kunzwa kuti mangwana watoko Australia. Watorowa pasi. Saka munhu uya akatenga imba haachakwanisi kana kuwana title deed because anenge achinzi at least imbobhadhara something for capital gains tax, hapana chakabhadhara. Saka kumitigate that, asati akupa mari, tinoendesa mari ini kana ndatenga imba kwauri handikupe cash nini. Tinoendesa mari kuna transfer secretary kana kuna conveyancers, lawyers aya. Inini ndonovapa mari, inenge ichinzi trust. Iwewe woendesa title deeds ikoko futi. Saka conveyancer uyu kana kuti transfer secretary ndiye anobva abata withholding tax oendesa kuzimura. Oprocessa zvese, ochinja ownership into my name. Anotorawo commission yake ipapo. Zvapera anobva andiratidza kuti tarisa ownership in your name. Asati andipa obva akuti mari yako net inini obva andipa title deed. Ndo madhiu ekutengesa dzimba iwe. Asi ingoti ukatenga imba kwandiriona kuti totosangana kubhawa kuti ndarama iti mune stand paipai uifana kubata 10,000. 10,000 tengeswe dzichinzwaro kana dzimba ndosika uchizoona zvichingonetsa. Vachizonzwa vakatengeserwa makuruku because kuruku uya abata mari yese haachazivi kuti kune chinonzi capital gains. Saka kuti atenga uya achiwana title deed mazino hazvichabude. So ndo purpose yacho iyoyo. Maibata. Saka ndo purpose yatinoti usati wapiwa mari rega deduct withholding tax. Saka withholding tax yakadai so. Sales of listed marketable securities. Sales of listed marketable securities. Securities. Ukatengesa listed marketable securities. Then withholding tax, capital gains withholding tax, not CGT. CG withholding tax, capital gains withholding tax equals 1% of sales proceeds. 1% of sales proceeds. 1% of sales proceeds. Iyi inenge yatova final tax, hapasina imwe tax ichabhadharwa futa. Kuma marketable securities inobva yatongoita final. Then kuma unlisted, remember aya withholding taxes. Unlisted, then CG withholding tax, capital gains withholding tax on unlisted marketable securities, 5% of sales proceeds. Ona ukavhura mapepa ekudhara like ukavhura question paper iyi anenge akatopiwa pamatables hazisi zvako zvekufunga aya anenge akatonzi capital gains withholding tax, immovable property. Immovable property it's 15%, listed 1%, unlisted 5%. Izvi zvirapa izvi asi zvinhu zvekuti ungambozvinetsa watengesa anonzi macapital gains withholding tax aya. Saka usafungidza sei vari kunyanya kuziva stereki, anenge atori mumatables. Even zvandiri kutaura zvana inflation allowance izvi zviri mumatables. Even zvandiri kutaura zverate of capital gains tax 1% on listed security, 20% on what, but izvi zvekuzoti was acquired prior to, disposed after, acquired prior to, disposed after, izvi chizviignore kakare ana February 2009 kwakare. Chingo ichichi hazvisina much of a deal, hatichakuexamine zvinhu zvekudharadhara zvakadai, handozvona. And ona ukatengesa principal of private residence kana uri over 55 years i 0% kana kuti exempt, ndozvari wangonyora mumanotes unenge wakatopiwa mumatables. Ona apa pandiri kuti withholding tax on listed marketable securities is a final tax, you know. Apa pari kunzi listed inenge yafinal but mamwe ese haasi final. Kurova kuti kana zvichinzi haasi final unoreva kuti iyi inofanira kubatwa musi wawatengesa wozonyatsokalculata kuti uwane tax, capital gains tax payable or refundable. Then withholding tax on immovable property, immovable properties, idzi dzinobatwa on sales proceeds. So capital gain withholding tax, CG withholding tax equals 15% of sales proceeds. Sales proceeds. So as you notice, unenge uinazvo mu exam. Right. So there you go. 15% of sales proceeds. So after tasvika ndakuudza purpose yema withholding tax ndeyekuti unofanira kuenda kuzimura uine inonzi withholding tax clearance certificate. Kuzimura hakungoendwe nemuromo unoti ndakaibhadhara saka ndipei clearance certificate. Saka kuti tikupe transfer property into your name pane inonzi capital gains tax clearance certificate. So write this: documents to obtain capital gains tax clearance certificate. Documents to obtain capital gains tax clearance certificate. Clearance certificate. What are the documents you need to one withholding tax, a capital gains withholding tax clearance certificate? Pane documents aunoda the app. Kura kuti uda kuprova kuna kuzimura kuti ndakatengesa imba yangu kana ndakatengesa imba kune munhu uyu. And wazvinotisa kuti kune zvekuti 55%, I mean 55 years and above, kura kuti kunotodiwa birth certificates, certified copies of birth certificates. Certified copies birth certificates. Kazhinji commissioner, why birth not ID? Anoda nyatsoona zuva rekuzvarwa. Pa ID zvinogona kufojerwa, but pa birth certificate ikashoma. Certified copies of birth certificate or IDs, national IDs. Unogona kungoti national ID tinomaka futi. National IDs. Document rekutanga. Another document is agreement of sale. Agreement of sale. Agreement of sale. Another title deeds. Kana tuda kuzati zvanga zviri zvako here. Title deeds or share certificates. Title deeds kana iri imba kana to building. Kana ari marketable securities toda ma share certificates. Tizoti watengesa zvinhu zvanga zviri zvako here. Another is proof of remittance. Proof of remittance of withholding tax wakuzviziva manje kuti of siege of capital gain withholding tax, of capital gain withholding tax. Toda proof yekuti sure wakaendesa capital gain, toda deposit slip kana kuti transfer. Then tinoda a completed capital gains tax form, capital gain tax form, some call it L10. Zvinhu zvekuzimura hazvitaurwa nemuromo, unoisa paform, and that form is called L10. You have to provide L10 inenge ichiratidza kuti sure wakaendesa this, zvese zvinofiliwa pa10, wofila maproper fields and stuff, right? And ndakuudza kuti kuna anonzi madeemed sale, madonations chichichi. Saka even ukaudzwa kunzi pakadonetwa mashares, munhu akadoneterwa mashares, anotori deemed sale. Market value yemashares iyoyo akadonetwa iwo at the date of donation inotoshanda kuti ticalculate capital gains tax. You get that? Saka pari kwambe kuti unenge usina kupiwa market values, unogona kungonzwa kunzi business iri rakafoswa kurelocata kubva kuGweru kuya kuHarare ende rikapiwa compensation iyi. Compensation yavakapiwa iyoyo ndo inenge iritori sales proceeds, right? So this is question June 2014. If you may allow me to send it to you. You know, I like the fact that you are hanging in there, guys, which is perfect. You know, this is what I want. And I'm going to ask that join dasara phone, everyone was there. Ndopita vana vechikoro. All right. I'm sending the document on our chat feature here. Okay. So I'm reading question number 3. Jacob and N Dube. You can access it on your screen. Jacob and N Dube, aged 58 and 53 respectively, have been horticulturalists for the greater part of their 30-year marriage. They carried on their horticulture business on a plot of land which they owned, situated adjacent to Matopo Resort in Blawayo. However, in recent years, the running expenses of the business have outweighed the income streams, and in 2013, the couple decided to dispose of the plot and their other business assets. The plot consists of a homestead, which has always been occupied by Jacob and N. Now, if they say the plot consists of a homestead, which has always been occupied by Jacob and N, meaning this is their PPR. This is their principal private residence. Okay, just a sec. Let me get a glass of water. I'm coming. Okay, guys, I'm back. So continuing, Jacob and N. Okay, so I was on the highlighted part where I said the plot consists of a homestead which has always been occupied by Jacob and N, meaning that is their principal private residence. That's another way of being told. And both permanent and temporary improvements in line with the business of horticulture. So they had a plot. Paplot apa pane manonzi business assets nemba yawo yekugara. And usaconfuse imba yekugara business assets. Saka staff housing haisi principal private residence. Staff housing business asset. Office building haisi imba yekugara business asset. Now, a local estate agent valued the property on 10 June 2013 as follows. So this is how the properties were valued. So they were valued to be 745. And then continuing. Jacob and N acquired the underdeveloped plot, meaning ayandoma estate valuation, kurandoma selling prices. Saka iwo wanga acquire plot musi wa 7 March 2009 for 50,000. Vanga vakatenga iri underdeveloped, meaning yave plot isina chinhu. And they effected the following improvements on a piecemeal basis, meaning my improvements vayaita up on up. Homestead ndobva vavaka muna 2009, staff housing muna 2009, permanent roads muna 2010, temporary garden sheds muna 2010, office building muna 2009, furniture and equipment, dams and bowls zvese through matractors muna 2010. Remember vakazotengesa muna 2013. Jacob and N signed an agreement of sale for their property on 20 June 2013 through their local estate agent. And the selling price was paid as follows. After vasaina vakatengesa selling price yacho yakabhadharwa like this. Vaiti imwe mari inobhadharwa on signing of the agreement, imwe inobhadharwa on or balance musi wa 31 October, except land yeland yaizobhadharwa next year. Saka iyi suspensive sale ndosaka ndaida. Then the other question is additional information. 10% of commission was paid to a local estate agent, meaning sales commission. Jacob and N signed another agreement on 10 November 2013 for the acquisition of their new a residential home in Northview, Plateau, Blaawai. Kuroti vakaita inonzi rollover. Inonzi rollover provision. Because chakaitika ndechichi. Homestead yavo panapa yakanzi ndeye 250,000. Kuroti vakatengesa homestead ye 250,000. Vatengesa homestead ye 250,000 ndokubva vashandisa imwe mari kutenga another homestead ye 200. Kuroti pane rollover provision. Pane rollover provision there, which is 80%. Kuroti 80% ye capital gain inobuda pa PPR haitexwe. That's one thing. Another thing is ukatarisa Jacob na N. Jacob ane 58 years, N ane 53. Kuroti even vakatengesa PPR umwe elder umwe haasi. Saka capital gain inocalculatewa zvakanaka yodividwa by 2. Ye elder haitexwe, ye umwe asiri elder ndo yaakutexwa. But nekuda kwekuti vakaita rollover provision vakashandisa 80% kunovaka imwe imba, zvine zvakureva kuti after taidivida by 2 ye uyu yaakutexwa i20% yecapital gain yake ndo yotexwa ne20% because vakashandisa 80% of the proceeds kunotenga imwe imba. Kuroti only 20% of the gain ndo yaakutexwa. Now, required. State any 4 documents which Jacob and N should present to ZIMRA when applying for the capital gains tax clearance certificate. This question I have already told you. This is the list of documents which Jacob and N should present to ZIMRA for them to get capital gains tax clearance certificate. Because vatanga vanonoenda kuZIMRA vonoti ini nda elder ina handisi saka ngatidai zvese zvinonzi tionei. tonei mabethse maid yenyu nechi. Ndosaka tichiti ukaona mumwe ane 53 umwe ane 58 maigona kungodhileya kutengesa ne2 years ka wozati imwe tax planning yaunogona kuvaadvisa ndeiyi. Ivo vanhu ivava unogona kungovapa tax planning yekuti ko vadi kungodhileya ne2 years. Vakadhileya ne2 years ka principal private residence iyi yakanzi homestead haizoqualify for tax, inenge yaexempt because vese vamaelder. Kana kuti ndo one way, kana kuti after vatengesa homestead ne250 kuti vaavoide tax ngavanongotenga imwe homestead ye250, vanotenga ye200 vaigona kungotenga imwe ye250 so that the full proceeds dzaenda uko hapasina chi tax. It's another way futi. Saka because of that vanoda kuisa maid nechi kuitira kuti zimu rainyatsoziva kuti maelders here. Now calculate the amount to be included in gross income of Jacob and Anne for the year ended 31 December 2013 as a result of disposal of their business assets. Now ukaona question iri capital gains tax but yoti what are the amounts to be included in gross income. Ndakuudza inini ndikati recoupment ndiyo chete inoenda ku gross income. Saka examiner akubvunza achiti tipe calculator recoupment, ayo anoziva kuti akati calculator recoupment unokasira wazvibata. Ndozvinoita maexaminers akati calculate recoupment right away watozvibata. Anongokuti calculate amounts to be included in gross income. Iwe ndio uchafigure out manje kuti ndeapi maamounts anopinda mugross income. Say vakati chi maamounts anopinda mugross income ku capital gains recoupments. Saka panapa pane papa ungoti B1 is illustration June 2014 B1 amounts to be included in gross income. Amounts to be gross income on sale of business assets recoupment. You know, it's merely what they are saying. So unotodzoka unasay kuti say exam ranga rakaoma mamusina kana recoupment, say dai recoupment yanga irimo ndanchiigona yeti recoupment yanga yakatozara itori ne 3 months. Amount to be included in gross income recoupment. Saka apa ndo pane business assets, hanzi on sale of business assets. So far havana kuti marketable securities and immovable property, vati business assets. And they unofanira kuziva kuti business assets include homestead. Homestead imbe yekugara haisi business asset. Saka business assets ndizo zvese staff housing, permanent roads, chichichi. Saka ndakakudza kuti kana uchicalculate recoupment unocreate table inonzi recoupment table yaunoti asset wobva wati panapa cost apa ITV wobva wati panapa ITV wobva wati ukati cost minus ITV unowana capital allowances. ITV inongori net book value. Saka ukati cost minus net book value unowana depreciation. Saka depreciation ku tax ndo inonzi capital allowance. Then wobva wati selling price. Then ndakati unowana inonzi potential recoupment. Potential recoupment. We calculate potential recoupment unoti SP minus ITV. Don't calculate a potential recoupment. Then was what actual recoupment. Actual recoupment. You know we can say actual recoupment. Actual recoupment ndekuti ndakati recoupment cannot exceed allowances previously granted. Saka recoupment haibvumidzwe kuexceed capital allowances. Saka ma-assets andinawo panapa ndogona kutanga kuuya nekuno. Ma-assets ndeaya staff land haina recoupment nekuti haidepreciate, but unogona kungoinyora kungoti ungoona, but uchaona kuti hapana recoupment sei. Staff housing ma-assets ese atiri kutengesa. Permanent roads, permanent roads, temporary garden sheds, temporary garden sheds. Ndiringolista ma-business assets. Office building, commercial building. Then furniture and office equipment, furniture and equipment, and then tractors, dams and bores. Ndakakuudza ndikati ma-assets anoqualify for outright allowances for farmers hapana recoupment kana achinge azoitwa disposed. Saka ma-dams and bores haana recoupment nekuti akaqualify for outright deductions. Then ndochiuya manje pa-selling price. Selling price is 100 homestead haipo, so it's 120. Say homestead isipo, inyaya kuti homestead but business asset 20, 120, and then 30, 50, 60, 30, 50, 60, 65 on tractors. Right, then ndoya kuma costs nema-ITV zviri pana. Cost yeland iyi yakapiwa pamusoro apa yakatonzi cost yanga iri 50,000. So cost yeland was 50,000 and they purchased it underdeveloped land, undeveloped actually. Then cost ye homestead haipo, so ndakutangira pazasi 40, 10, 20, 30, 50. 40, 10, 20, 30, 50. 40, 10, it was 40, 10, 20, 30, 50, and then 45 on tractors. Then ITV is given here. Homestead not applicable. Staff housing 0, 2.5 Chidzika 0. On land ITV it's 50,000. Reason is land doesn't claim capital allowances. Land does not claim capital allowances. On staff housing it's 0, 2.5 on permanent roads, 0 here, 2,500. Then on temporary garden sheds, now they are telling you that temporary garden sheds it's not applicable, meaning you need to take it out. When they say it's not applicable, they are simply saying this wasn't claiming capital allowance, so not applicable, take it out. And then office building 27,000, 27, 1, 2, 3. And then furniture and equipment 0 and 11,250. Furniture and equipment 0, the other one is 11,250 on tractors. Now capital allowances is the difference between cost and ITV. difference between cost and ITV. So you do notice land does not claim. So these are your capital allowances. Now, potential recoupment. Recoupment is the difference between selling price minus ITV. That's potential recoupment, the difference between selling price minus ITV. But actual recoupment, now, if you now need the actual recoupment, you compare this column of potential recoupment and this column of capital allowances. So there is capital, you compare column for potential recoupment and column for capital allowances. Kurikupa kutora your money back. Saka commissioner kana achinzi ari kurikupa macapital allowances. Saka recoupment haibvumidzwe kuexceeda macapital allowances. Saka paactual recoupment uchanotisa kuti paland pane 0 nekuti potential i50 but capital allowances is 0. Recoupment haifaniri kuexceeda macapital allowances. Then pastaff housing pari kunzi recoupment i100,000 potential but macapital allowances ndeye 40. Saka unotora 40 because recoupment should not exceed capital allowances. Then per permanent roads, potential recoupment is 17,500 but apa is 7.5. Total 7.5. Total ma capital allowances because recoupment cannot exceed capital allowances. Office building, pakanzi 23 but my capital allowances is 3. Total 3,000 because recoupment cannot exceed allowances granted. Then office equipment pane 60 but pana ma capital allowances is 50. Saka tinotora chi? Tinotora 50. Reason, recoupment cannot exceed allowances granted. Then tractors pane 53 but my allowances there, my capital allowances there 33. So what do we do? Tinotora 33,750 because recoupment cannot exceed allowances previously granted. So amount to be recognized in gross income then is 134,250. This is now recoupment to be recognized in gross income. Recoupment to be recognized in gross income. That's your way. That's your 3 marks. So it's important to know your things very well. But imagine all this is 3 marks. Then question number B says, calculate capital gains tax payable by Jacob and N on disposal of their business assets, not homestead, business assets. Now, capital gains tax payable for the year ended 31 December 2013 and 31 December 2014. Capital gains tax payable for the year ended 31 December. Capital gain tax payable for the year ended 31 December 2013 and 2014. All right, so there you go. Now just pay attention. Surely you thank me come the exam time. As a point to note, NB, movable property, only immovable property is eligible gains tax. Capital gains tax in this question. Now, why in this question? Because if there were shares, they would also be eligible. But in this case, we are not given shares or anything. We are just given business assets. Now, all these are business assets, but furniture and equipment and permanent roads. I mean, furniture and equipment and tractors. These ones, we don't include them. Why we don't include them is because these are not immovable properties. Only immovables are what we consider. So we say gross proceeds or sales proceeds you know, or let's say disposal proceeds. Disposal proceeds. Now, disposal proceeds, we are given disposal proceeds by the estate agent here. That it was like 745, but we don't take the full amount here because it includes movables. We only take, so what is the things that we have to include? Homestead, we exclude it. Why homestead is excluded? Because it's not a business asset. We also exclude temporary garden sheds. Why are they excluded? Because they are not immovable. Temporary means they are movable. We also exclude furniture and equipment because these are movables. We also exclude tractors on the same reason they are movables. And we take the rest. So we don't just say disposal proceeds and take the total. No, because the total excludes things which are not eligible within for capital gains tax. So we take these ones. We take these ones. Copy, paste. And another thing that we have to take is dams and balls. Dams and balls. Dams and balls. So there you go. So what were the disposal proceeds? You have them one by one. These are the selling prices here. Disposal proceeds. So if you, oh sorry, you have them one by one like that, through to office building, through to, now dams and balls, it's not there, but it's given here, which is 70,000. So dams and balls 70, 1, 2, 3. Now after getting disposal proceeds, you then tally them up. 340, that's your disposal proceeds, and then you say less recoupment. Now recoupment, we had said if any, in this case there is recoupment. Now the recoupment that you take, you subtract is the recoupment on these. So it's a matter of taking these as well, put them here, copy, put them here. Now notice the recoupment, it's not 134,250 which you bring here, because 134,250 includes recoupment on tractors, recoupment on furniture and equipment. We only take recoupment which is eligible to immovables. So recoupment which is eligible to immovables is equals minus, because we are saying less. This is the recoupment which we take, recoupment on these from the, you remember we take actual recoupment. So there you go. After you have taken the recoupment, you then say capital amount, right? So capital amount is 289,500, and then this is now capital amount. Then you say deductions. Right? Deductions, you take cost. Now, if you are taking cost, remember there's cost of land, there's cost of everything here. All these that we have considered here, they have a cost here. So there's a cost of land, housing and stuff. What is the cost? We have the figures already, equals. It's easy when you have, so this is the cost. So you scroll through to office building, you take costs, and then we have dams and balls. What was the cost of dams and balls? You get it from here. It was 35,000 here. 35,000. So the cost of dams and bores was 35. And you say less capital allowances, less allowances granted for income tax. Now, capital allowances granted for income tax. This is you notice in this case it is the same as recoupment. It's same as recoupment because recoupment cannot exceed allowances previously granted. So it's same as recoupment, which is 40 plus 7,5 plus 3. 40 plus 7,5 plus 3, so equals minus sum. So it's equals minus sum of this. Actually, it's equals sum, not minus sum, because we are taking it out. So there you go. And then you say inflation allowance. Remember, the reason why we take out capital allowances is because they were granted for income tax. It is the same reason we take out recoupment here, because it is taxed under income tax. So capital allowances are included in the cost, but they are deductions from gross income. So what it means is, if we don't take them out here, you benefit twice. Then you say inflation allowance. Inflation allowance. This is, it's 25% per annum on cost. So we need to do it asset by asset. So if you say inflation allowance, always know that you do it like this. You copy inflation, you copy all the assets again, because you have to calculate inflation allowance on every asset. Right. After copying every asset, you then say land. You disposed in 2013, but land you acquired in 2009. How many years? 9, 10, 11, 12, 13, 14, 9, 10, 11, 12, 13, 5 years. So land, it's 5 years. So you say 2.5%, 2.5% times 50,000. That's the cost. It's the cost is just here. 50,000 times 5 years. 5 years. That's about land. Then staff housing. We acquired staff housing in 2009. Permanent roads in 2010. So staff housing is still 5 years. Permanent roads 4 years. 9, 10, 11, 12, 13 years. Staff housing 2.5% times 40,000 times 4 years. Remember, you include even the year of disposal. Permanent roads is this one is still 5 years, sorry. Permanent roads is 4 years. 2.5% times permanent roads 10,000 times 4 years. Then office building was 2009, meaning 5 years. Bores 2009, meaning 5 years again. Bores 2000, so the rest is 2009. 2.5% times 30,000 times 5 years, and then here it's 2.5% times 35,000 times 5 years. You get it. So you can then just say equals 2.5% times 2.5% times cost times right. So those are the with the exception of staff housing, where we have, with the exception of permanent roads, staff housing is 5 years, not 4, because with the exception of permanent roads, where we have to put 4 times 4. Are you not seeing my Excel shortcuts? I am very good at this because I don't want to waste much of my time. Then sales commission. Capital allowances are deducted. They are negative here. Capital allowance, they are negative. They are deducted under deductions. In other words, deductions are net of capital allowances, so to speak. Sales commission, we are told that sales commission was 10% of selling commission, 10%. So it was 10% times, not it's times the sales proceeds, zinechekuita necapital gains tax, times 340 irapai, times 340, 123. So sales commission is 34,000. Right. So it's expensive sale. So what we have now is your total deductions. It's equals minus sum ema deductions. Yes, could I like this? So these are your deductions. So what you get, if you do it like this, you then get capital gain 126.25. This is now capital gain. But this capital gain, there is an installment data outstanding. We are told kuti land inozobhadharwa next year ish. Land ish inozobhadharwa next year. So you have to calculate what is called suspensive sale allowance. Suspensive sale allowance, because the land ichabhadharwa next year. So what do? You then say suspensive sale allowance less suspensive sale allowance. And suspensive sale allowance yacho tatinowekwa sei, unoti capital gain, which is 120,625 divided by disposal proceeds. Disposal proceeds aunotora ndeaya ecapital gain chete. Usazotore disposal proceeds ari kusanganisira nezvinhu zvisinei necapital gains. Usatore 790. Unotora ane chekuita necapital gain, which is 340, 123, multiplied by installment debtors outstanding. My installment debtors outstanding at 100,000. That's how we calculate suspensive sale allowance. You say capital gain, you say equals minus capital gain over gross sales proceeds rinechekuita necapital gain multiplied by 100, 123, which is the installment debtors outstanding. So after doing this, you have suspensive sale as 35,777. Then you say taxable gain. This is now taxable gain. Taxable gain. Taxable gain, you subtract suspensive sale. So in the first year, you are going to tax 85. After you deducted suspensive sale, you are taxing 85. So then you say CGT at 20%. CGT at %. You then say equals 0.2 times this. So capital gains for 2013 is 17.029%. And then you then say, because On suspensive sale allowance, I said something. I said the allowance for each year is taxed in the following year of assessment. I'm sure you have heard me saying that. The allowance for each year is taxed in the following year of assessment. So it will be like year ended 31 December 2014. That's now the following year to this. Ona reason yawakapiwa allowance iyi yanga rekuti macustomers ako asati abhadhara, vacho wawakatengesera vasati vabhadhara, saka gain iri mu100 kureva kuti gain iri mumadebtors asati abhadhara ngairege kutaxwa. Gain iri mumadebtors asati abhadhara ngairege kutaxwa, nekuti mari dzese i340, total gain i120, asi pane madebtors e100 asati abhadhara. So by proportion ukati 100 over 340 times 120 unowana gain iri mumadebtors asati abhadhara. Now kana ya2014 akufanira kunge abhadharawo because mari yacho yakauya, saka unobva wati year 2013 suspensive sale allowance, year 2013 suspensive sale allowance, year 2013 suspensive sale allowance. So you pick that suspensive sale allowance there, 35477. iyoyi ndo inobva yataxwa because that will next year. So unobva wati CGT capital gains tax at 20%, which is equals to 0.2 multiplied by this. You are done. I wanted you to see the suspensive sale aspect and I wanted you to get it right, and I'm sure you have now managed to get it right. Now allow me to do another question. You know, this is because these things are equally important. Now this is June 20, so let me close that one. This is how you should be doing every day. Doing papers, don't even tire. Just imagine, as you say, I teach 28 subjects and all of you are writing in June. And I then give you just a single subject called tax. And I say, can you practice this? And already you are saying, say, I can't, I just can't. Are you not saying you can't be saying that to yourself? Mary and Mark, so they are saying, assume today it's 1 August 2014. You know, the beauty about capital gains is there's no need, there are no thresholds of saying this was in dollars, this was capital gains, we just do it the same way we would do it in dollars, we would do it also in domestic currency. So that's the beauty of it. And I said, you in the course of your reading, you shall see the 22 February 2019, that was overridden in 2020, it's no longer relevant. Mary and Mark and Mary are married and jointly own the principal private residence which they reside in. Mark was born on 15 July 1960. You need to calculate the age of Mark. And Mary was born on 24 December 1959. The couple are contemplating disposing their PPR. An estate agent has provided the following market values as at 31 August 2014. So these are the values at 31 August. So let us now calculate. Can you calculate age of Mark and tell me? Do that Mark are how old? Mary are how old? Calculator tone. Notice time they do famba wake I fast. What do I say? Do I have people here? Wekai. Male are how old?
Married.
Alright. Okay. So you're saying Mark 54, male 55. Right. Kuvarungu zvinoitika kuti murume mukadzi mukuru kune murume. It's fine. Right. So here is the deal. Kureva kuti zvazviri kureva ndezvekuti uyu anonzi Mark uyu ari kusvitsa anonzi Mark ari kusvitsa 55 musi wa 15 July 2015. Kuroti nhasi tichiri muna 2004. Mark achasvitsa 15 July 2015. Mary akatosvitsa. Saka zvazvinoreva ndezvekuti vakatengesa PPR, tati PPR yakadisposwa naelder iri exempt. Zvino iyi jointly owned PPR. Kuti vabenefite from tax, it's either tomirira kutanga Mark asvitsawo 55. Kuroti tomirira kusvika 15 July 2015. Kuroti next year. Uyu mata akatosvitsa. Ukati 2014 minus 1959. Yes, uyu akato uyu i2014 uyu anosvitsa 55. Mera anosvitsa 55 musi wa wanyatsogona kuweka here. Mera anosvitsa 55 musi wa 24 December 2014. Ati asvitsa here. Because kana uri wa59 muna 2000 waiva ne2000 minus 1959 muna December 2000 wanga wane 41. Kuroti muna 2000 muna December 2014 ndopa unosvitsa 55. Unosvitsa muna December. Zviri namunyatsoweka because ndosaka kuchidiwa mabirth certificates zvinofana kunge zvakanyatsoweka. Main residence, outbuilding, temporary car shelter. Kana yakatonzi temporary up zvinoreva kuti haisi movable. Iyi inobviswa pakucalculator capital gains tax. Concrete wall and lock-up garage aisa anopinda. The estate agent has advised Mark and Mary that whilst there are many buyers interested in their property just now, they should consider selling as soon as possible in the case the market falls. The estate agent's commission is 10%. Kuroti estate agent ati garai matengesa as soon as possible. Tengesa as soon as possible. So akati tengesa, of course estate agent anenge achida mari. Ndo imwe reason iyo. Saka question iri pakuti explain why, notwithstanding the estate agent's advice, Mary and Mark should consider delaying disposal of their property. Advise on any tax planning which could be undertaken to allow them to sell at the earliest date possible, whilst availing the maximum tax reliefs. Right. So, iratingati earliest. So, kuti the tax planning tichaita under tax administration. The tax planning kurati kuita Tuesday. The tax planning kurati how best can they plan to minimize tax. Saka vanogona kungo delay ka votengesa musi wa 24 December 2014 sorry. Vakango delay ne because nhasi hanzi idzi 31 August. Kurati vango delay na September, October, November, December. Vango delay ne 4 months. Mary atopa 55. Saka in the event kuti va delay ne 4 months. Zvava kungoita vanongocalculate capital gains but half yayo haitaxwe because mary anenge asisa 55 hafu haitaxwe. Kana kuti vodhileya vese kusvika musi wa15 July 2015 vese vaabove 55 ppr yacho haichatekswe, disposal inenge yaexempt. Ndozvinongonzi nyora. Calculate capital gains tax payable by Mark and Mary. Now apa waungocalculata sezvataita apa. Notice chawaakuchiita mai ndechekuti kana tikatengesa ppr haina macapital allowances. Remember, macapital allowances anograndwa on business. Let me repeat and let it sink. Macapital allowances anograndwa on business assets. Unopiwa macapital allowances kana uchiita business, kwete ppr. Ungati sekuru wako vari kuwaterfalls, vari kugara imba yavo kuwaterfalls, vanoda macapital allowances. Imagine uchizvifunga izvo muexam. Zvauri kuedza kureva ndezvekuti vanoclaima depreciation. Uri kuona kuti maumaanza ukafunga neshona unofanira kuzviseka also. Vanoclaima depreciation paimba yekugara, vari kuita business ripi. Saka imba yekugara wazviona panapa haina recoupment, haina macapital allowances. Saka unongocalculata sezvataita apa. But in this case zvese zviri apo izvo hazvina recoupment uye hazvina this capital allowance. Woprocedure wocalculata manikirikinaro. If you say Mary are 55 years, zvazvinenge zvichireva ndezvekuti wawana capital gain, wasvika pacapital gain panapa. Wasvika pacapital gain apa. Haubva waiti CGT at 20%. No, unobva wati less exempt gain for Mary. Mary because are 55 years. Yasara yacho ndoya unozobva wati. Saka unoti 50% because it couples. Yasara yacho ubva waiti CGT at 20%. Wona tatoita question. Ndo zvandei ndichiti itai. Yatopera yakadai. Wakutovhura next. We are meeting next week when we are discussing tax planning. Cheers guys. Enjoy the rest of your afternoon. My pleasure. Bye.
Bye. Thank you, sir.
You're welcome. Saka yatopera topic iyoyi.